Amandeep Chopra as well. He's the president, head fixed income at UTI Asset Management Company, who now joins in on the show. Amandeep, of course, this fall is reminiscent of what we've seen in previous market crashes. Do you think, first up, that the reaction that we're seeing is justified, or it's a bit amplified or exaggerated?
I think the background clearly is the uncertainty around impact of coronavirus both on global economic growth as well as the impact on the second round growth estimates. So I think the uncertainty is clearly spilling over into the markets, and you've actually seen most markets behave in a very similar manner, largely driven by what happened firstly in the developed markets, and then that's been sort of spilling over into our markets as well.
What is the right way to judge that this entire impact of coronavirus, whether it is recession or contraction, is in the price?
So I think from a fixed income markets perspective, clearly the revision in growth estimates are going to spill over, particularly in not only central bank actions going forward, but also, the markets are now pricing in a series of rate cuts from the central banks across the world. You would not be surprised, because if you really, read through the economists' latest study on the potential modeling that they've done on impact of coronavirus, they actually feel that, over 2 quarters, it can shave off up to 200 basis points from global GDP. So when the global GDP is already struggling to, just reach 3% target, shaving off 2% does have a meaningful impact across the world, and particularly not only consumption but also in terms of trade. So I guess given this backdrop, it would not be difficult to assume that the central banks will continue to be dovish in the near term, and the earlier assumption that you would actually see a V-shaped recovery just because this could be more of a short-term phenomena is now getting scaled back.
We have seen a real sell-off. I won't say the word sell-off, actually. We've seen a drop in yields, at least both locally and globally. Inflation fear for the moment, given that crude and commodity prices have fallen off, will automatically get crushed. What does that mean? What does that indicate? Do you think this is an indication that the world's going to slow down and you need to worry about it?
I think so, and this is particularly more, I would say, a difficult position for India to be in, because we already are facing, a slowdown which we thought was bottoming out. Clearly, we will see the latest quarterly GDP release today, but the markets were of the view that the growth slowdown that we've been witnessing over the last 18 months seemed to have bottomed out, and at least we would now start seeing recovery into the next financial year. Given this global event, I think that growth recovery will now need to be reassessed. Like I said, if you expect global growth to also ratchet down going forward, then it's difficult to assume how we can show a meaningful uptick in growth going forward.
The way the alignment of world is right now is that central bankers, they continue to commit more liquidity. Yields are coming down, and low interest rates so far have only delayed recession. Are we in for this dreaded R word, which frankly was not the scenario at the beginning of the year? I mean, are we looking at growth contraction and are we looking at a very ugly downpour of economic activity, at least for the second half of this year or the remaining part of this year?
I think that's going to be a tough call right now, because like I said earlier, we don't have any yardstick to really measure the impact of coronavirus except what the economies have faced in the past. At the current juncture, like I mentioned, there is clearly a more optimistic view hinting at a large part of the spillover from coronavirus broadly on economy sort of settling down by the summer season. If that really happens, then I think you can actually see a much better second half of the current calendar year. But till then, clearly, like I said earlier, the quarter ending, June is going to be quite a stress for most of the markets. But on your second point, are we seeing a sustained low, interest rate environment? I think that's very true, because if you've seen over the last decade, whenever the central banks sort of got some degree of confidence that the growth is back and they can actually roll back all the easing measures they've undertaken, unfortunately, something or the other has always kind of made them switch that view back to turning dovish. And this is just another trigger point for a sustained dovish stance as far as central banks are concerned. Nobody will be in a position to really start tightening rates because this only keeps pushing growth further out. And you must understand that while we are currently only talking about the near-term and immediate impact of coronavirus, the analogy I would give is very similar to demonetization. We really are not aware of what the second round impact really happens, because the first round impact clearly is a fair amount of consumption which gets deferred, travel which gets deferred, trade because of the travel restrictions also gets deferred. But this deferment of the business activity, like the earlier instance of demonetization, spills over into possibly a fair share of small and medium enterprises shutting down because they do not have the wherewithal to sustain low business activity for more than 2 quarters. And that, I think, is the second order impact which can also continue to sort of keep growth under pressure.
Amandeep, what's the sense that you're getting when it comes to the overall fund flow situation? Do you believe that in an environment like this, we can see flows ebbing off with respect to emerging markets and, of course, India?
So I think the immediate impact, which is typically knee-jerk for most global investors, will always be to, de-risk. And since the Indian markets have been a little late in this, sort of correction or maybe, adjustment for the new data and news flow around coronavirus, clearly, they've been a little ahead of others in pulling money out. So we've seen actually net outflows both in the sovereign bond markets locally as well as on the equity side. I think if the view does not change, the risk off mode may actually continue to keep most of the foreign portfolio flows somewhat, on the sidelines.
I want to go back to this whole scenario, what we saw when bond yields last time were at 6%. It happened after demonetization. When bond yields came to 6%, it started a huge economic activity. It started, gave birth to a lot of lending in the NBFCs because liquidity was abundant. We're almost back to those levels. Bajaj Finance is telling me that they're borrowing at levels which are almost at demon levels now. So what happens to NBFC in this scenario when liquidity is back and yields are low?
So I think, couple of differences between this and the earlier situation. Firstly, you're right, liquidity has clearly been made abundant in the system, and the LTRO is only going to add to that. But this time around, actually, most of the transmission of easy liquidity and the rate cuts which were undertaken in 2019 have impacted the tier 1 borrowers, the highly rated and well-known issuers. So most of the transmission has actually been felt by them. The tier 2 issuers have actually seen only very recently some spillover of these benefits. That's actually sort of originated right after the 6th February RBI policy. So the AA rated issuers have only now started seeing some of those benefits. I think going forward, if we continue to see a low interest rate environment and the existing liquidity being in the current sort of zone of plus 3 odd trillion rupees, then I think the risk appetite is going to start coming back, because your benchmark yields, whether these are deposit rates, overnight rates, are going to be so low that investors will again start looking for something which is offering a decent spread. Will it take the risk appetite to exaggerated levels like we saw in the earlier NBFC growth phase? In my view, possibly not this time. That's again driven by first, the NBFC sort of event is still fresh in the memory of investors, because we've hardly completed 18 odd months since the IL&FS issue. Secondly, the regulatory regime has become a lot more stricter and vigilant this time around. So I would choose to believe that there is definitely a lot more oversight on the type and the kind of growth which the financial sector sees in this time. But if you really were to look at slightly longer term, as history has shown, periods of very low interest rates, ample or surplus liquidity in the system does create some stresses in the in the sort of lending framework, and also for the borrowers going forward. We just need to sort of be watchful of that.
Joining us then today, Amandeep, and for taking us through how you're viewing the current sharp fall that we're seeing across the globe.